AIG. It's our fourth largest position. For perspective on position sizing, AIG is a 6% stock position, and then we own a 2% position on top of that in what are TARP warrants, which are these unique securities that the U.S. government got as part of bailing out AIG and some of the other financials that are 9 years they have left to go on them, somewhat out of the money, but we think a very interesting and levered way to own the upside on AIG for the next 9 years. So AIG, your viewers will probably wrinkle their noses and think of that horrible tainted company, and as value investors we love that reaction. It was the same reaction we got in the couple years ago when we were buying BP stock while the well was still uncapped and pouring oil into the Gulf, and we made a whole lot of money on that. When they finally capped the well, the stock popped by 50%. In this case, AIG used to be one of the most complex businesses in the world, very difficult to value. Today, it's dramatically simplified. They've basically sold off enormous parts of the company in order to pay back the government. And the good news for we taxpayers is the government had $182 billion in AIG. That's down to about $45 billion. The government just sold another $6 billion today. And we think there's a very clear trajectory over the next year or two, barring a complete collapse of the markets, for AIG to continue selling some remaining assets. And what you will be left with is a business that just has two components, a global property and casualty insurance business called Chartis, and a mostly domestic life insurance business primarily called Sun America. And they're not that hard to value. And then currently they've got some other assets that they're in the process of selling, an aircraft leasing business, collection of mortgage portfolios, mortgage-backed securities called Maiden Lane, and they own 20% of one of China's largest insurance companies called AIA. As they sell off those assets, they're going to generate $20 to $25 billion. And this is just from those selling off those three assets. And as all that money comes in, the company will be retiring more and more of the government stake. The government, after today's sale, owns about 60% of AIG stock. And a lot of investors don't want to own because the government's a very motivated seller. So that's a big overhang on the stock. But our view is the stock today trades at a 41% discount to tangible book value. It's great to have a motivated seller who's willing to sell at that kind of discount to book value, with the company having liquidity to buy back meaningful amounts of what the government is selling. Now, they can't buy back 100% because the government needs to have a market price, but in today's $6 billion offering, the company bought back $2 billion. And so if AIG can continue to buy back a third of everything the government is selling, they can buy back another 20% of their stock, let's say, over the next year and a half or two. And that will increase book value per share substantially because the company's buying it back at a 41% discount to book. So we think it's a win-win. Either the stock's going to go up and we win, or the stock stays down here depressed, allowing the company to buy back the government stake at a very attractive and highly accretive price, and that will just increase the upside down the road.